Now, composite tax. Composite taxation scheme. Now in GST, there are two methods we can follow. What are they? One is regular value-added tax concept, like tax on sale or supply, or tax on output minus tax on purchase or supply input. So tax on output minus tax on input, net we will remit. That is regular value-added tax concept in GST. Now there is another thing, that is composite tax. Now composite tax scheme, who can take the benefit of it, and is it beneficial? That we can have a look into. Now composite tax scheme, it's available for whom? Where turnover is less than or equal to 1.5 crores. Turnover is less than or equal to 1.5 crores. Then a person can opt for composite scheme. So turnover of less than or equal to 1.5 crores. Now, who are they? One is manufacturers, and traders. Manufacturers and traders. What is the composite rate applicable? 1%. For manufacturers and traders category, composite rate applicable is 1%. That means on the output, on the sale price, if they just pay 1%, if they just collect 1% and pay to the government, suppose if they just collect 1% and pay to the government, that is enough. So sale price plus 1%, whatever is the value. Suppose sale price is 100 rupees. So 101 if they collect, and 1 rupee they remit to government, that's enough. But here the set off of tax on input will not be available. So manufacturers and traders, but they will be free from lot of clerical work, filling in forms, and multiple other benefits are there. So that we will discuss. So first we will discuss how whom it's applicable, what percentage is the composite tax, and is it really beneficial. So manufacturers and traders, on the sale price, on the output price, 1% if they collect. So 100 rupees is the sale price or supply price. On that 1%, so 101 will be the output value. In that 1 rupee, they remit to the government. That's done. It's done. So this is composite tax. Output, on output, the percentage is just 1%. Now there is another category, that is restaurants. Restaurants which do not sell liquor. Restaurants which do not sell liquor, for them it is 5%. So suppose sale price or supply price is 100, they have to collect 5% thereon, that is 5 rupees. So 105 will be the output value. In that 5 rupees they have to remit to the government. Again here, input, tax on input will not be available for set off against this 5%. So 5%, just like that, on the output price they have to pay, remit to the government. So composite scheme for restaurants which do not sell liquor, it is 5%.
So, sir, any amount, any turnover for the restaurant which do not sell liquor, or if their turnover is 1.5 cr, then only they have to pay, or any
Correct.
amount.
So less than 1.5 crores only the scheme is available. More than 1.5 crores, they have to go for a normal value-added tax concept. That is tax on output minus tax on input. They have to set off tax on output minus tax on input. Balance only they have to remit. That value-added tax concept which we have discussed in GST 1 session 1.
Correct.
That is applicable for once they cross 1.5 crores turnover. Regular
So
value-added tax concept will apply.
Okay, less than equal to when the turnover is less than or equal to 1 cr, then only this will be applicable.
Correct. So that is told by we will have a look into CBIC website. So either it will be coming in the form of circular notification like that. So we will have a look into CBIC website.
Okay.
CBIC, that is Central Board of Indirect Taxes and Customs. Central Board of Indirect Taxes and Customs. Okay, now we discussed two varieties of people. One is two categories of people. One is manufacturers and traders, less than 1.5 crore turnover. They have to pay, they have to collect 1%. Then we discussed restaurants which do not supply liquor.
5%.
They have to collect 5%. Then we discussed then one more category, other service providers, others. Other service providers. Other service providers, it is 6%. So suppose sale price or supply price is 100. Tax thereon is 6%. So 106 is the total output value. 6 rupees they have to remit to the government. Tax on input is not allowed to be set off. Set off is not possible. So 6 rupees they have to pay to the government. So three categories: manufacturers and traders, two restaurants which do not supply liquor, three other service providers. So for manufacturers and traders, it is 1%. So restaurants which do not supply liquor, it is 5%. Other service providers, it is 6%. So on output value, the percentage is added 100 rupees plus that X percentage, 1%, 5%, 6%, whatever. That X amount has to be remitted. 1%, 5%, 6% has to be remitted to the government as it is. There is no set off available. Tax on input cannot be set off against that amount. Now, the question is whom it's applicable? Three categories of people. If turnover is less than or equal to 1.5 crores. Now, once they cross 1.5 crores, they will be compulsorily coming under regular GST system of value-added tax concept. That is tax on output minus tax on input. Rest has to be balance has to be remitted to the government. Now the point that has to be thought about, which is more beneficial. Suppose let us assume the trader, a trader. Let us take an example: a trader. Turnover is less than or equal to 1.5 crores. 1.5 cr. Now, whether composite tax scheme is beneficial or regular value-added tax scheme is beneficial. Let us take an example. Initial sale. That example we have discussed in GST session 1. So initial sale, 100 rupees is the Initial sale 100 rupees is the sale price by the initial seller. Now tax thereon is 18. So output value is 118. Tax thereon is 18. Output value is 118. Now 18 rupees. This 18 rupees that initial seller will remit to the government. Done. Now second sale, that is subsequent second sale. The person has purchased at 118 inclusive of tax. So in this tax purchase value without tax is 100. Purchase value with the tax component is 18. This is on purchase. Now coming to sale or supply. Now that person is selling at 200.
Yes, sir.
Okay.
Yes, sir.
Okay. Now you mute your mics. Now we were discussing the example. Seller 236. Subsequent second seller, his input output price, that is sale price 200 plus 18% GST, that is 36. 236 is the value. Now in this 236, now if he goes for composite scheme, what happens? If he goes for value added tax scheme, what happens? Let us take composite scheme. So composite scheme, how much is the tax net cash he will be left with? So tax on output is 36. Tax on input, tax on output, that is sale value, is 36, less tax on input, that is purchase price, minus 18. How much he has to remit to the government? Remit to the government 18. So now in this case, what is the sale price? Sale price is 236. That is the amount collected by the seller, subsequent second seller, less tax remitted. Tax remitted. How much? Minus 18. So how much he will be left with? He will be left with 218 net cash. So seller 236 he will collect, 18 rupees he will remit to the government. That is value added tax concept. We are using the word, we are using VAT concept. So VAT concept. In this, what is happening? Subsequent second seller, he will be left with net revenue of 218. 236 minus 18 rupees tax remitted. Output tax minus input tax 18. The difference 236 minus 18, 218 he will be left with. That is the net cash available. And what is the profit he has made? 218 minus purchase cost is 118 inclusive of tax. 218 is the net cash available. Purchase cost inclusive of taxes 118. So profit that he has made is 100. Accounting profit that he has made, is 100. This is VAT concept. Net cash left is 218. Net cash left is 218. Purchase cost is 118. Accounting profit is 100. Okay. Now let us go ahead with composite scheme. Suppose he opts for composite scheme. What is the profit he'll made, and what is the compensation? What is the net cash left with him? So 236 out of how much is the composite scheme tax rate? 1%. Composite scheme tax rate is 1%. So we'll keep the sale price at 236 only. Whether it is 18% tax or whether it is 1% tax, the sale price or MRP, sale price or MRP, let us take it at 236. Now what happens? How much tax he has to remit to the government? That is 1 divided by 101. If 100 rupees is the sale price, 1 rupee is the tax. So for 1 divided by 101, for 101 invoice bill, 1 rupee is the tax payable. So for 236, how much is the tax payable? So calculate. Rajendra, calculate. How much it will come to? 1 divided by 102, 101 into 236. Sale price is 236. In that, if you remove tax, that is 1 divided by 101 into 236. That will come to how much? 2.33. That is minus 2.33. Now 2.33 is the tax that is included in 236. So let us take a round figure of 3 rupees just for ease of calculation. So 236 is the sale price minus 3 rupees is the tax that is remitted. What is left is 233. Actually, it is 2.33. For ease of calculation, we have taken 3 rupees. So 233 he will be left with net cash. Now let us calculate net cash available in composite scheme for the seller, and also let us calculate profit. So net cash, what is the left with? 233. That is 236 minus 3 rupees. 233 net cash he will be left with. And what is the cost? Purchase cost remains same. That is 118 he has paid, inclusive of taxes. So what is the profit? Accounting profit that is left? How much? Accounting profit that is left is 125. 125 or 115?
115.
115. So 233.
But sir, in this case, government will be at a loss.
Take minute. First we'll finish off this example. Okay. Now net cash available is 233. Then tax remitted is minus 3. 1 minute. Net cash
plus 18.
Net cash available is 233. Then purchase cost remains same. That is 118. So accounting profit, what we are calculating is accounting profit. Accounting profit is 115. So in this case, if you observe, net cash is 233 in composite scheme. Purchase price is same, sale price is same. Purchase prices remains at 118, inclusive of taxes. The difference that is happening is at outputs on the output side. MRP is 236. So if MRP is 236, if tax is 18%, what happens? If tax is 1%, what happens? Composite scheme and value-added tax concept, what happens? So net cash in value-added tax concept. Value-added tax concept. Another is composite scheme. Net cash. What is the net cash? Value-added tax concept. It is 218. And what is the net cash in composite scheme? 233. And what is the accounting profit? Accounting profit in VAT concept, it is 100 in our example. And what is the accounting profit in composite scheme? That is 115. So if you observe, which is more beneficial for the trader, in this case, small scale trader, less than turnover of 1.5 crores, which is more beneficial? Obviously, what is more beneficial is 115. That is composite scheme. So
Sir, my question is.
एक minute. So now first we'll finish up this. So net cash available under VAT concept is 218. VAT, 1 minute, composite scheme. So net cash, here it is 218. Composite scheme, it is 233. VAT concept, it is 218. Composite scheme, it is 233. Profit, it is 100 under VAT scheme. Under composite scheme, it is 115. So for a small scale trader, it is beneficial to go with composite scheme. In addition, lot of clerical procedures will be reduced. Filling in forms, filing returns. There at every stage there are benefits. So what is the intention of the government? For small scale traders, they want to make ease of operations, because otherwise what happens? Small scale trader, they have to hire an accountant, lengthy pay for accountant, then other fees, this fees, that fees. Small scale trader, should he spend on filling in forms or clerical work, or should he concentrate more on business? Our objective of the government here, it's a benefit given to small scale traders. Objective of the government is to encourage the small scale traders so that they don't have to worry about set of procedures, all that. And in addition, it will leave a little surplus also. If you observe in this example, under VAT scheme, profit left is 100, whereas in composite scheme, it is profit left is 15 rupees more. In this example, because the things will change based on percentages of composite rates or percentage of GST rates applicable. So in this example, the trader is left with additional profit of how much? 15 rupees. Additional profit of 15 rupees, additional cash of 15 rupees, he'll be left with. Now, yes, ma'am.
When we are talking about, sir, when we are talking about composite scheme, so initially 18% tax will be levied on 100 rupees by the to the manufacturer. He will be paying 18% only.
No. Initial sale, he will not pay anything. See, he has purchased.
So we have
example,
taken the.
Ek minute.
So
in our example, one is initial sale. Initial sale, he'll sell at 100 rupees plus 18. That will come to 118.
I got it, sir. So,
no,
sir,
no, 1 minute. Coming to second sale, this will become purchase cost. 236. Now 236. 1 minute. 236 the MRP. 1 minute. MRP. Then purchase cost is 118. Purchase cost remains same. We are talking composite scheme versus value-added tax from the angle of second seller. We are analyzing composite scheme versus value-added tax concept from the angle of second seller, where purchase cost will remain same. Whether he opts for VAT scheme, whether he opts for composite scheme, purchase cost remains at 118.
Okay.
What changes? MRP also remains same in this example. 236 only we are taking MRP. What changes is tax component. In the VAT scheme, it is 18%, whereas in the composite scheme, it is 1%. In the VAT scheme, set-off is available. In composite scheme, set-off is not available. Set-off of input tax on output tax is not available. So in the VAT scheme, tax rate in this example is 18%. Set-off of input tax and output tax is available. In composite scheme, tax rate is 1% in this example. Set-off of input tax on output tax is not available. So here in this example, First seller, it doesn't make any difference. Second, subsequent seller, purchase cost also there is no difference. It remains at 118.
Okay.
Difference is happening not even in MRP. We have taken an example of MRP of 236. So where the difference is happening, the difference is happening
Tax only.
at tax component. So that tax component will make a difference in net cash left with the second seller or profit made by the second seller. So if he goes with the composite scheme, he will be left with additional profit. Now, is that what government wants? Yes, that's what government wants. It is a benefit given by government to small scale traders, restaurants without selling liquor, and other service providers where turnover is less than. So turnover if is less than or equal to 1.5 crores. One is they will be, if they go for composite scheme, they will be left with an additional profit, a small additional profit, or maybe sometimes it may be huge also. One is in terms of profit, in terms of net cash. Another is lot of clerical procedures they will be avoiding. So this is how composite scheme versus value added tax concept works.